Good afternoon. Market news now. Most Asian Pacific markets fell sharply after heavy losses on Wall Street overnight. Hong Kong's Hang Seng Index was amongst the biggest losers, regionally falling 2.5%. Shares of Chinese tech giant Tencent plunged 6.5% after reporting that its quarterly profit halved. Other Chinese tech stocks in the Hong Kong sector also saw heavy losses, with Alibaba falling about 7.3%. Mainland Chinese stocks bucked the overall trend regionally as they closed higher. When we look at the U.S. market, stock futures under pressure a day after the Dow Jones experienced its biggest one-day drop since 2020. To talk to us about the latest dynamics when it comes to the markets, we are joined by Connette van Zyl, who is a portfolio manager at Absa Asset Management. Connette, thank you so much for your time. Given what we saw on Wall Street overnight, if you look at the performance of the Dow Jones, S&P, as well as the Nasdaq, how's our markets reacting to some of the concerns that are coming through, especially as investors look at what high prices are doing to U.S. earnings?
Yes, so a very rare day across the board on the JSE. All major indices at the moment down more than 1%. A nice fashion process also down more than 1% at the moment. And we are really following international markets lower, as you've said previously. Last night in the States, both the Nasdaq and the S&P 500 closed down more than 4%. Europe, again, today also under pressure. So really a very rare day. And this is all on the back of refreshed concerns around inflation. On Tuesday evening in the States, out of the Fed, we had more hawkish tones coming out of them, saying that they will do whatever it takes to bring US inflation under control. And in the UK, we had inflation numbers published for April. It was more than 9%, the highest inflation rate that the UK has seen in the last 40 years. So clearly a big risk-off environment at the moment.
So you look at Tencent and you take into consideration the disappointing earnings as well as some of the downbeat comments from the executives. What does that mean for an industry that's had to deal with a clampdown that's affected the e-commerce, fintech, as well as the gaming sector? I mean, what's your conviction on Tencent and that overall market?
Yeah, so even after the results, it was a disappointing result. In Hong Kong, the share traded down nearly 7% yesterday. And the issue is really that these tech stocks are all high growth companies that have shown very strong earnings growth over the last number of years. And we have seen that growth number halving. And the comments that came out of Tencent itself, both in its gaming division and its advertising division, is that growth will most likely continue to slow even from current levels. I suppose the one positive thing is that the regulation and the regulatory environment in China did seem to be a bit more positive, and that more games might be able to be released by Tencent. But the growth outlook at this stage is still under pressure, and likely it will continue to be under pressure from this point onwards.
Speaking of under pressure, you look at Massmart's earnings, not pretty at all. What did you make of their figures?
Yeah, so they released a sales update for the 19-week period, ending the end of March. And it was really disappointing. As I looked a bit earlier on, the stock was down nearly 8%. So investors clearly not liking that result. Sales for the group decreased by 0.2%. And a lot of that was actually driven by the operations outside of Africa. Outside of South Africa. And they also flagged increased costs. They're seeing cost pressures both from product costs as well from supply chain costs. So yes, definitely a disappointing result update from them.
So yesterday you get an announcement from Rhodes Food Group, and as a result of what they highlighted, that share price took a 19% knock. So you take the dynamics and some of the pressures. I mean, then how do you view food retailers versus the food producers? I mean, what's your assessment on either one of them? Is there a particular sector that you like between the two?
Yeah, so we actually have quite a high conviction call on this in the portfolios at the moment. We prefer food retailers over food producers. We have got very little exposure to food producers at this point. And the simple reason for that is that your food retailers, although they have cost pressures, they are better able to put price increases through to consumers, which means in an inflationary environment, their earnings hold up better. Your food producers are very much price takers when it comes to their inputs, so commodity prices, wheat prices, maize prices, etc. And we all know what's happened to those and the inflationary pressures there. Their sales and revenue is determined by what they can pass on to the food retailers, who will be their customers who buy from them. And because we have so few, big shopping supermarkets and food retailers in South Africa, they have quite a bit of muscle to push back on price increases from the food producers. So what typically happens in a high inflationary environment is that your food producers see margins coming under pressure and you see their earnings coming under pressure. So our preference is very clear for food retailers at this point over food producers.
Let's talk share buybacks. You had Baldwin Properties announcing a share buyback. And then when you look at the trading statement from Lewis, some saying that this is indicative of, I suppose, call it value creation potential when a share buyback program, is instilled at a company where, it's trading at low multiples. Speaking of share buybacks, when is the right time for a share buyback?
Yeah, so ideally you would want to do them when you think that your share price is depressed or when it's trading at a low multiple, because that will be earnings enhancing, and because at a per share level you would be increasing growth. It would also mean that, as a company, you are enhancing shareholder value. So I've got no issue with them. And ultimately or optimally, you would want to do them when you think that share prices are depressed. I think that, it's always better for a management team when they see limited opportunities, either to pay out the dividend or do the share buyback and leave it up to shareholders to decide to invest that capital. Because we've had so many instances in South Africa where companies do acquisitions at the wrong time and just ultimately destroy shareholder value. So I've got no issue with them, and I suppose at the moment, given how weak markets have been, it is a good time to do share buybacks. The only consideration is the liquidity of the stock. I mean, a stock like Lewis or Baldwin, those are not very big companies with big free floats. So the only consideration for a management team should be what happens to your free float and liquidity on a stock when you are buying back shares in the market.
In an hour and a half, we'll have Lesetja Kganyago, the Reserve Bank governor, announcing his interest rate decision. Your expectations on that front?
Yeah, so I think the consensus expectation is for a 50 basis point rate hike. We had the April CPI numbers released a couple of days ago, and it came in at 5.9%, which was in line with expectations. This is at the upper end of the targeted band that the SARB targets. So I would be very surprised if we don't see that 50 basis point hike. In fact, I think if we only do a 25 basis point hike, people might be concerned. It might be perceived as negative, as we won't be able to bring inflation under control in South Africa.
Connette, thank you so much for your time. That is Connette van Zyl, who's a portfolio manager at Absa Asset Management. We are going to be having our interest rate decision at 3 o'clock, and I'll be back hosting that particular MPC special decision right here on SABC.